Welcome to another edition of Southbank Daily. So I thought that I would talk today a little bit about currencies and purchasing power and value, because a couple of different things have happened in my life that really taught me about currencies and purchasing power. The first was I got back from Australia in about March of 2000, and I'd been selling cable TV and phone connections door to door in Australia, and I'd been doing very well from it, and I thought that I was pretty flush with cash. But then I rolled up in London and I suddenly found that I was getting £1 for every $2.65. So suddenly I took this huge haircut. And I found that I didn't have very much money at all, and I was just lucky that I saw an ad in the Times for Bloomberg salespeople, applied, and I was amazed at the speed with which the Royal Mail got my application in and back. I posted it on Tuesday. I had a response on Wednesday, and I had an interview the next Monday. So it was really quite spectacularly quick. Then, subsequently, the Australian dollar almost doubled. So if we just look here, that at one point it was at $3, and by the time we got around to 2013, the the pound had basically halved versus the Australian dollar. So if I'd been coming back from Australia in 2013, my dollars would have gone a lot further. Now we're in this prolonged ranging phase. So now let's just think about all of this. The more back history we get, well, we can see that there's been bouts of extraordinary volatility. And there have been times when the Aussie dollar was strong, and there have been times when it was weak. And each of those times was preceded by a range and then a trend. And now we're seeing this very prolonged ranging phase. But it does beg the question, if this is a base formation and the pound is appreciating, well, why isn't the Australian dollar doing better? I mean, everyone is talking about the UK, that there are intractable problems, that inflation is out of control, the Bank of England is impeded from raising interest rates, there's this big jump in mortgage fixings about to appear in over the course of the next 12 months. Consumer demand has been under pressure, and the number of home sales has been deteriorating, and yet the pound is rising. Then Australia, the so-called lucky country, where they have been able to avoid a recession for decades, where the country has been running surpluses, and the Australian dollar, and I'll just show it to you, versus the US dollar has been trending downwards. So there's something else that's going on. Now the Aussie dollar has stabilized over the last 24 hours. And part of the reason for that is because the budget deal was passed in the USA. What it effectively does is remove the debt ceiling until January of 2025. That basically gives free rein to US politicians to spend as much money as is required. And they can also come up with additional spending measures over the course of the next 18 months to boost, for example, military spending. And that is a virtual certainty, considering the fact that the war in Ukraine is still ongoing. But the primary reason why the Australian dollar has been weak is because the RBA was slow in raising rates, was pretty sanguine that they would get inflation under control, didn't really get that done. But then you have this bigger issue about China. A lot of the exports that Australia benefits from go to China. And the renminbi has been weakening. This is the uptrend we've seen. This move higher was the renminbi weakening. And China's economic growth has not kept pace with expectations. So their economy is not expanding, and in the same manner like we saw following the end of lockdowns, uh, and the pandemic in other countries. And I think a good part of the reason for that is because they were pretty miserly with the volume of uh, money that they were willing to send out into the wider economy. So consumers did not really benefit from the pandemic in China like they did everywhere else. Now, one thing that I think is particularly relevant is that the property market is under pressure and the property developers have not rebounded. So this is just one representative example. Now, this is important because China is a major economy and they're not pulling the stimulus lever just yet. But they will eventually have to. And when they do, there's going to be a lot of money printed. And they've just started to pull the lever in the USA. So that means the money printing is starting there already. And the US Treasury is going to have to refill its coffers, which means they're going to be issuing a lot of short-dated debt. Now, that is part of the reason why the pound has gone up. It's also part of the reason why gold is rebounding. So gold has now found support in the region of the peaks from back in January and February and the lower side of this range that's been forming for the last couple of months. And then we have this roundophobia, which is right around this psychological 2000 level. So gold has been going sideways since the middle of 2020. And now I think it is looking increasingly likely that this little range that's been forming is nothing more than a consolidation. And as we move into a more stimulative environment from the USA and then potentially from China, although not quite yet, well, then gold is beginning to price that in. And then we have this additional wrinkle in the global economy, which is oil. So oil prices have been bobbing along for most of the last few months. And you have OPEC ministers warning short sellers that they will be shocked by the actions of OPEC. But then Russia, having said that they would curtail supply, has not done so. And India, for example, is crowding out Saudi Arabian imports by buying even more Russian oil. Well, that is going to start to create competition within OPEC. And what we definitely have right now is the price steadying at the lower side of its range. But in order to really demonstrate that we're back in a clear demand-dominated environment, well then this year-long sequence of lower rally highs will have to be broken. So I think oil is still a bit touch and go here. And it's really a question of how much economic weakness are Chinese authorities willing to tolerate before they stimulate? And will they first need to see some major decline in commodity prices? Will they have to see more bankruptcies happening in the property sector in order to act? These are the open, outstanding questions. And then you have a third string to all of these and all of this, and it is that there is an evolving mania in the uh, artificial intelligence sector. Nvidia has been the go-to stock, and this is very much an argument, or the argument investors have been using is simple. In a gold rush, you're better off selling picks and shovels. So nobody really knows what the end point is for artificial intelligence. We have lots of promise, but we do not know what the use cases will be and how successful they'll be or how reliable they'll be. We've definitely seen examples where people have been using artificial intelligence, and even in the legal profession, they've had briefs written, and then they sound very convincing, but then the case law cited is incorrect. So then that is obviously opening up fiduciary lawsuits against people. That could really be problematic. There have been deep fakes created by AI turning up in Google searches. Then they're quickly suppressed. But the reality is that the search engine does not know what is true, what is fake. So there are teething issues. That's absolutely understandable. But the reason I call it a mania is because when we look at something like Salesforce, for example, so this is one of the beneficiaries of artificial intelligence, and they expect to integrate AI into their various products. They came out with earnings, and their prediction for what sales were going to be was not exactly enthusiastic. They said they're going to be good, but not nearly as good as investors were hoping, so the share pulled back really quite sharply. But then it recovered intraday. So now the big question for some of these stocks is going to be what happens next. Are they going to ramp higher from here? Or are we going to move into a ranging phase and a lengthier period of convalescence where we just think about, well, what are the promises and then how realistic are they? So C3.ai, I was listening to their CEO speaking at the recent MIT conference. Very engaging character, been in the industry for a very long time, and made a very clear point of saying that they turn away business. Therefore, it's not perhaps not that surprising that they didn't come through with a world-beating sales record when they're turning away business. So I think that we've definitely seen an interesting development here. That what we're definitely seeing is a narrowing of breadth even within the artificial intelligence sector. And it is the exceptionally large caps continue to do well. And I do want to highlight that this ratio I created several years ago. So if you take the 8 large FANGMAN companies, so that would be Apple, Amazon, Alphabet, Meta, Nvidia, Netflix, Microsoft, and Tesla, and you add them together, you get all their market caps, then you divide that by the total market cap of the entire US market. Well, those 8 companies are now clearly outperforming again. They've rebounded in an exceptionally impressive manner this year, led higher by Nvidia. But now you also have Apple, that is right in the region of its all-time peak. And there's a lot of excitement around the announcement of its uh, mixed reality or virtual reality and augmented reality headset. Now, it's anticipated to cost somewhere around $3,000, which is certainly not cheap. And it is multiples of what the Meta headset costs. Personally, I'll be looking for any kind of indication of whether they've solved the eye strain issue, because I personally have one of the Quests and I can't use it for more than half an hour at a time on any given day because I get blurry vision after it. And maybe that's just a factor of my age. But if this is going to be a mass market product, then people are going to have to be able to use it on a frequent basis. And I don't know whether they can solve that issue. So that's the thing I'll be paying particular attention to. But certainly there's a lot of enthusiasm both around artificial intelligence and how it can be integrated into other kinds of product. And the metaverse and that whole promise that was so popular 18 months ago. Then on top of that, the question of AI and its application in search and making that available in real time right in front of people's eyes. That's something that is certainly the dream. But we absolutely need to see whether it is actually realizable. So we're certainly in an interesting environment right now, and there is a lot of enthusiasm around, despite the fact that valuations are really quite expensive and interest rates are still high, and this is being fueled by the promise of much more liquidity. The liquidity taps are really only just beginning to open, and we're still not at a point where interest rates have started to come back down again. I think with that, I'll leave you for the week, and I'll wish all the best to all of you.